Well, the Australian market set a stunning new all-time high, but immediately after that, it pulled right back. So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 22nd of July, 2025, and before I begin, you do need to be aware that whatever I say is general advice only. Alright, the big topic of discussion this week, and probably in the coming weeks, will be company earnings. Currently we're in the middle of a US company earnings reporting season. That season has so far gone really quite well. I think about 84% of companies have exceeded their earnings expectations so far, and the average number of beats for their market is about 75%. It's funny that, about 75% of companies beat earnings expectations. It is a bit of a scam, but the fact that even more than that have outperformed it means it's a slightly better than normal season. While it has been positive for share prices, US markets have really struggled to break their resistance levels. Overnight, the S&P 500 pushed above it on the open, but it pulled right back to the resistance level by the close, and that was even after some fairly strong reports. For the rest of the week, there's going to be some really big names. A lot of the largest companies on earth will report in the US this week. Following that, we've got the Australian reporting season, and where the US reporting season has been quite good and showing relatively strong earnings growth, the Australian reporting season is expected to show another year of no earnings growth for our market. Pretty poor results from Australian companies. It's been about 3 years now without any real earnings growth. And in that time, the share market's rallied 25 to 30%. I believe the first major company to report results for Australia is Rio Tinto. I think that's on the 31st of July or maybe the 1st of August. And after that, they're just going to come hot and fast all throughout August. So yeah, pretty underwhelming reporting season expected here. That might mean that, a low bar is easy to beat, but it also means that if there wasn't a global rally in just about everything risk asset related, the Australian market would be nowhere near the current levels. We also heard an update from the RBA today. We got their meeting minutes for the July meeting, and they basically outlined their case as to why they didn't cut at the meeting, where everyone assumed that they would. In the accompanying minutes, they pointed to a fairly tight labour market. Now, they didn't have the benefit of the June jobs data, which came out after the July RBA meeting, and that basically showed pretty bad jobs data. It showed a big rise in Australian unemployment, and so the justification for, or one of the justifications for not cutting in July, which was the jobs data, seriously weakened after the meeting. So that basically means that we are going to get a rate cut in August. They can't point to a tight labour market after the jobs market update, and it might mean that the RBA may be slightly wrong-footed by how weak the one, the jobs market, and two, the economy really is here in Australia. Also, just reading into the words, I think the RBA might have put a little too much stock in what's happening overseas. They began the minutes by pointing to continued economic strength in other parts of the world rather than in Australia. And I think a bit of a risk for the RBA is they're too focused on what happens overseas, where we are seeing pretty clearly an economic slowdown here in Australia. Their job is to affect the Australian economy. So they should be more closely watching what's happening at home. Regardless, the statement had nothing we didn't already know, other than, they were perhaps a bit wrong-footed by how weak some of the subsequent data has been. So it does mean we're going to see a rate cut in August. Some people out there are calling for, a double rate cut, a 50 basis point rate cut. I don't think we'll see that. I think that'd be pretty silly. But I think we'll see a cut there. And then I think we'll probably see some more cuts later on throughout the year as well. Otherwise it was a pretty unimportant monetary minutes. Didn't really have anything we didn't already know. And finally, I wanted to end on the balancing act between the miners and the banks. We've seen the miners jump pretty strongly over the past couple of weeks, and that's with a big jump in iron ore prices, as well as some other metals prices. At the same time, we've seen the banks really come off, and indeed, on Monday and today, in particular, the banks saw some fairly strong selling. And I just wanted to sort of highlight to people that it really is a balancing act for our market. If the miners are doing really well on the back of perhaps high iron ore prices, that does mean we're going to see selling in the banks. That's simply because it's unnatural for our market to be this expensive. So there's plenty of selling on the index, there's plenty of selling on the futures, plenty of bear calls and puts and options selling and things like that. Keeping our market at somewhat reasonable levels, keeping our market somewhat tied to the US market. Yet if that's happening and the miners are also rising, it means some other part of our market is going to have to compensate to make sure that our index as a whole doesn't skyrocket or doesn't go out of sync with what's happening elsewhere. And that is the banks. So it means that we've seen the banks fall off purely because the miners have rallied. It also because the banks are extremely expensive and they do have that valuation room to come down by. I really do think it sort of points to a sort of theme we've been touching on here for quite some time, and that is it doesn't really matter what necessarily is going on for a particular stock at a particular time on a particular day. It really is the index as a whole and how that's moving. And especially for the banks at the moment, they've completely ignored their own fundamentals. It's just moving relative to what other it's basically acting as a derivative of the market. It's moving as to what other parts of the market are doing. If they were responding to fundamentals, CBA would probably be 50% cheaper. Maybe not 50%, but $60, $70 cheaper than it is right now. And like I said, we are also going into an earnings reporting season with the market so distanced from what the individual stocks are doing. This could be a season where we see pretty dramatic moves in either direction. So let's have a quick look at the charts for this week, guys. And we'll start with the US chart. And as I mentioned, they did try and go through that resistance level overnight. They were fairly strongly higher early in the session. However, late selling pushed them right back onto that resistance level. Let's say roughly 6,300. They do also have a medium-term uptrend line. You can see that line drawn in on my chart. And that leaves them right at the tip of an ascending triangle pattern. Now, generally, when we see an ascending triangle pattern, we expect that it's going to break in the direction of the underlying trend. That's what we saw here back on the 24th of June. The market broke through the resistance level, and it broke to the upside in the direction of the uptrend, and then it continued higher for a bit. If that plays out here, if we get a nice bullish bar above 6,300, that'll indicate further upside. Not sure where the market will head to, but we should see further gains. If we have a quick look at the XJO, the Australian stock market, we can see that we had our own breakout on Friday. We had a huge jump through the roughly 86.30, 86.40 resistance level. We came right up to sort of about 87.70, finished around 87.50-ish, 87.60-ish. And yeah, just a monumental move higher. Unbelievable. Definitely a bunch of short covering, a bunch of readjusting. And then, once that shockwave sort of settled over the weekend and, after US markets didn't break higher, we saw a pretty strong drop in Monday's session. It doesn't look super bearish though, because we have held the previous resistance as support. And often you see this, you break resistance and then you test it as support. We've seen it hold as support so far. And, that to me, that looks mostly bullish. I would just caveat that by saying that in the past where we have set fresh highs, particularly in 2024, maybe early 2025, we tend to have pulled back pretty quickly. So I'd be watching for about 86.40 to break to the downside. If it does, I think we'll see a move back towards 85.50, 8500. If we hold above 86.40, we should see a return to the sort of 87.50 or above level. As I mentioned, the Australian market is unnaturally expensive up here, extremely expensive. We haven't seen companies grow their earnings on average for 3 years, and yet over those 3 years, if we have a look on our chart, we've seen a dramatic rally. We are coming into an earnings season. Will that be, a sense of reality returning to the market? Will valuations return to normal? I'm not so sure. To be honest, I think the global everything rally is going to continue for for as long as we're seeing the extreme US government money printing and expectations of interest rate cuts. Once the borrowing and the money printing can't be sustained, and once interest rates can't go any lower, that's where we're going to see, I think, reality return to investors. So I will wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click like, click subscribe, and we'll see you guys next time.